Hi friends. In the last video, I have presented with concept that will be discussed in this chapter. The first concept is measuring cash flows and technique used for project evaluation. First topic deals with estimation of project cash flows. While financially analyzing the long-term investment decision involves estimation of cost of asset and estimation of benefit receivable. What is estimation of cost of asset or project? It involves determining the expected cash expenditure that will be incurred if the project is selected. It will occur only in the current period, hence it is represented as cash outflows. And the other one is it is the estimation of benefit receivable in the future period if we select the project, and it is represented as cash inflows. If you look into this, first one is occurring in the current period and the second one is occurring in the future period. It will be difficult to analyze. For this, what we are going to do, the second one, future benefit which is occurring in the future period, it will be converted into current period. For this, we will use the discounted factor to arrive the present value of the benefits. For estimation of benefit, what are the methods we are using? Cash inflow approach and accounting profit method. What are the difference between the two? Cash inflow approach gives a time value of money and it is superior and theoretically better measure of economic benefit, whereas accounting profit method gives accrual concept and it includes non-cash items, example depreciation. Also, there will be a difference in accounting policies, method of valuation and procedures chosen. For evaluating the financial viability of proposal, two scenarios involved. If it is a new investment decision, only incremental cash flows occurred, whereas in replacement, both incremental cost and incremental benefit occurs. Cash flows related to proposals are initial cash flows, subsequent cash flows, terminal cash flows. What is the initial cash flows? It is a large amount of cash spent for acquiring the asset or project. What should be considered for estimation? What are the costs to be considered for estimation? The first one is the initial cost, that is the cost of the asset, installation cost, transportation cost, and incidental cost which is incurred for making the asset ready for use. And the other cost we going to check is sunk cost or committed cost, which is already incurred and have no effect on present or future decision if it is irrelevant to the project. So we have to find these costs and need to ignore it while we are calculating the total cost. Then change in working capital requirement. And then if we are replacing the existing asset, what are the things we need to check? If we are replacing the asset, find the salvage value of the existing asset which need to be deducted from the outflow of the new asset. If there is a only asset, that is the only asset in the block of asset, we have to add or deduct the tax payable on gain or tax saving on loss on sale of asset. If there are other assets too, then sale proceed will be deducted from the outflow related to the new asset. What is the outflow related to new asset? While we are buying the new asset, we have to spend the cash. That is the cash outflow. So in that we will deduct the proceed we receive from the sale of the old asset. Initial cash outflows. How we calculate? First we have to find the cost of the asset. In that, if it is a increase of working capital, then we have to add. If it is a decrease of working capital, then we have to subtract. In case of replacement of old asset, we need to deduct the salvage value of the old asset. If there is a one asset in the block, we have to deduct the tax savings or add the tax payables. And the second cash flow is subsequent cash flow. Subsequent cash flow again divided into conventional cash flow, non-conventional cash flow. In this scenario, in the conventional cash flow, cash outflow occur only in the initial period and cash inflow occur in the subsequent period. Whereas in the non-conventional cash flow, intermittent cash outflow occur in the subsequent period. Example, repair, additional working capital, etc. So for the intermittent cash outflow, we have to find the present value. What are the things important for estimating cash inflows? Cash inflows to be arrived after deducting taxes. Once the tax is deducted, we have to add back the depreciation, which is non-cash item. Then interest, which is a financial charges excluded for estimation of cash inflow. If it is a interest on debt capital, cost of capital used for discounting the cash inflows to arrive present value. What we have discussed is given here. Cash inflows can be found using the three values. If in the question net sales is given, we have to deduct the cost of goods sold and general expenses and depreciation to arrive PBIT. If PBIT or EBIT given, we have to deduct the taxes and add back the depreciation to arrive the net cash inflow after taxes. If profit after tax alone given, then we have to add back the depreciation, then add interest net of taxes, then net cash inflow after tax will be arrived. Then last cash flows is terminal cash flow. In the end of the life period, salvage or scrap value will be created for the old asset. In that, if we sell the asset, tax saving will be created on our loss. If gain on sale of asset, then tax burden have to be deducted. In the end of the life, working capital will be released. That should be added. That will be the inflow. Tax burden is the outflow. Tax saving is the inflow.